There's so much pain in my body, it's like that old town road, yeah. And I don't think they can stop me, cause to the top, yeah, that's where I go, yeah.
All right. What's good with y'all, man? Your boy Quay back. Another video. Let's get right into it, man. As the title of the video say. Video title is how I don't know the video title yet, I ain't gonna lie, but it's something about how to stop failing at Forex, all right? And a lot of this has to do with psychology, but today I'm gonna be getting into more than the psychological aspect of it. I'm getting into skill set. Excuse me. Let's get right into it, man. So first off, explain 2 trades I took, dropping down to the 1 second time frame. But all right. First, what you have to understand is the market isn't a bunch of buyers versus sellers. All right. You had to understand it off the rip, off the dribble. It's not a bunch of buyers and sellers, man. It's a few people who control the different currencies of a nation against the masses. So yeah, you're probably thinking, oh, this got a lot to do with smart money. Yeah, it does. But you got to ask yourself, do you really believe that the people who have full control over the nation's currencies are just letting it free form and do whatever it wants to do? Just letting them, just letting the money just do whatever it wants to do. Just, oh, we're gonna let the people, we're gonna let the masses control however much they buy. If they think the euro should be higher, let them buy it, make it go, keep going higher. I think the US dollar should be also buying, let them buy that too. No, they control the nation's currencies in a way to keep it as liquid as possible. And yes, the people of the London session, they work together. People of the New York session, once the people at London session get off, the people of New York session come in and say, hey, how did London session go? What do we need to do to accomplish something good in New York? Well, I need you guys to sweep out all these orders, all this liquidity, a term that you should know. I need you guys to sweep all this liquidity, which is nothing but money. I need you guys to sweep all this pending orders and then bring price back up for the rest of the rest of the day going into Asian. Okay, bet. And that's what they do. Because you got to think, before I even break down these trades, the reason why orders are filled so fast on MT4 is because the dealer, they take the other side of your trade. It might not make sense, but that's what they do. They literally take the other side of your trade. Why do you think in the older days, they had to call a broker, they had to do all this, that, the other, and they had to, some of the times their orders wasn't getting filled because there just wasn't enough liquidity or whatever in the market. Well, the reason why it gets filled so fast now, because your dealer, your broker, central banks, all them, when you buy, they're risk managing their positions against yours, selling. So when you buy, they sell. When you sell, they buy. So if that's the case, how does smart money work? Well, smart money aligns itself with what the composite man, the central banks, the composite man is what Richard D. Wyckoff called it, but they align themselves with what the composite man is doing. That's why smart money works, and people get ridiculous trades from understanding the footprints of what the composite man wants to accomplish. So let me break it down a little bit more. So if it's millions of people selling at this resistance, They sweep liquidity, and all of a sudden, Billy Joe, who knows smart money, after they swept all the stop losses, he gets in the sale after they swept out all the sellers. You think they're going to take the market back up to Billy Joe? You think they're going to take the market back up to Billy Joe to take little Billy Joe out of his position? No. They're going to let Billy Joe ride the wave with him because they collected most of the liquid orders that they were trying to get. And the few people who did happen to get in, slide their orders in with them, they're of no concern. It's like you putting in a 10 lot on your broker with the move that the composite man wanted to make. And you're like, oh, they might come back and stop me out because I got a 10 lot. Dude, they probably just swept billions of lots if you knew what the composite man was doing and you got in when he got in. Now, let me kind of break down these two trades. All right. Look like they hit stop loss, right? So let's just go down to the 1 second and explain the first one, right? This is what I caught the trade on. I think I caught it on the 1 second. No, I didn't. I caught it on the 5 second, maybe. The other one I caught on the 1 second. Yeah, I caught this on the 5 second. So as you can see right here, what does it look like to everybody? Looks like a trend line, right? Yeah, looks just like a trend line. Price is bouncing off this trend line. So people are doing what? Or people are loading up on positions all across this trend line, right? Stop loss is probably under that trend line. And yeah, they're loaded up. They're like, oh yeah, this trend line's market's already bullish. Price gots to go up, right? Wrong. The central banks, the fourth phase of the bank cycles, they're gonna bring price down, bring price back up, create liquidity. Basically, that's pending orders, stop losses, all that are getting piled under here by millions of traders. Sweep that, push price up. Once I seen it get swept and price started pushing back up, I entered here and rolled this trade to before it came back and stopped me out at break even. This trade ran a 1 to 6. This trade ran a 1 to 6. Yeah. All off of the 5 second time frame. So no, I didn't need to look on the 1 hour, the 5 hour, the 10 hour. I didn't need to look at any of it. Why? It's pretty simple. I knew the main thing is if you can't see the liquidity where the masses are getting in, then you become the liquidity. Because what you have to understand is anytime you see consolidation in the market, it's not congestion or anything going on. It's not just the market not moving. The composite man, the market makers, the central banks, whoever you want to call them, either accumulating or distributing price, collecting orders from retail traders and they're collecting orders from retail traders and inducing people to get into the market so they could take it in their desired direction. Because the definition of trading is you give something to get something. So you buy something to sell something. That's trading. You buy something to sell something, right? That's trading. So understanding what trading is as a whole, the central banks just can't, oh, I want to take the market up to 33,000. This is US 30, for example. I want to take the market up to 33,000, but I have to induce people to sell or buy so I can get my orders filled, because it's a trading process. If I want to get 1 billion lots filled, I have to get the masses to fill in 1 billion lots all together to be able to get in. So what do? Induce people to buy here, buy all types of stop losses, all those stop losses and sell limits, because people probably got sell limits down here as well, like waiting for the breakout. As soon as it's in a breakout, a lot of people probably put sell limits right here, like, oh yeah. I mean, not sell limits, but sell stops. Yeah, sell stops. They probably piled up on sell stops when they thought they seen the breakout of this trend line. Then price, all it did was sweep the liquidity and push back up. So, and what did it do after here? It also take out anybody who was trading this as a double bottom. Not a double bottom, but basically a resistance. I mean, a support. They swept that and pushed price up even more. But me understanding the fact that the banks were inducing people to buy, to take them out, to push price back up, it put me on a different level of understanding. Did you see? The central banks know 90% of traders fail. So they do the most logical thing to do. Induce people, cause widespread panic, get them to take a trade that isn't really a logical trade. It's just a trade that seems good, feels good, but it's not exactly where they really want the market to go. Because this breakout trade someone would have took right here, let's just be honest, you probably would have got stopped out in literally 2-3 seconds. Does that mean you're a bad trader? No. Can you make a lot of money trading any strategy? Yeah, you can. But you have to understand that the composite man, they manage risk against your positions. They also know when you're in margin trouble. You ever been in margin, your account starts flashing red, and all of a sudden it's just like price just keeps pushing against you until your account is fully blown. Then price starts moving in your favor. Well, the dealers can see when your account is in margin trouble. And they also can tour with spread, but everybody knows that. Just call it, oh, that's a B-book broker. You know, but it's a lot deeper than that, you know. So what you got to realize is this trade I took, to explain it from retail to smart money thinking, people saw this as a trend line. This trend line got took before it continued to go back up after it swept liquidity under this trend line. It faked people out, making people think this was a breakout trade, and pushed down even more, inducing more people to sell, thinking they're going to miss out on this breakout trade. After that, price pushed up, not giving anybody any time to really just close out their positions like, oh, I was wrong. And most likely they just had to ride this move the opposite way until the composite man decided to bring price down once more to mitigate risk and sweep out other positions, absorb liquidity under here and mitigate their own risk to take price even higher. So what do I mean by absorb liquidity? Well, liquidity, people probably had sell stops and buy limits right here in this area. So they swept that, absorbing the liquidity and mitigating their own risk from having to sell the market down to buy it back up, mitigate their own risk and continue price higher. So let's talk about the next trade I took. This one. Oh, I'll close it here. I thought. And this trade ran a 1 to 12 before. If I would have, I could have caught the whole move, but I didn't. So yeah, this one ran a 1 to 12. These are both trades I caught this morning. This one ran a 1 to 6, and this one ran a 1 to 12 before getting stopped out at break even. I think I could drop to the 1 second. So this was one I did catch on the 1 minute. So let's go back to it. All right. So what did I see? So on the 1 second, you probably think, how does this low time frame help you out? So on the 1 second, right, a range was created, price bouncing back and forth, inducing buyers down here and sellers down here. What did they do? They swept all that. So everybody who had stop losses under here, everybody who had stop losses under here got stopped out. So the people at the central banks see this, right? People at the central banks see people that have their stop losses. Because I'll draw it out for you. I mean, what this looks like. I mean, just literally a support and resistance. If anybody took my course, you would know that this looks exactly like 4 phases of the banks. Banks create liquidity, take liquidity, push price above it, also taking liquidity from the buy side, showing their intended direction, bring price back to that area to mitigate risk because they had to sell the market down to buy it back up very extremely hard. And when you sell the market down and buy it back up, they end up leaving sell positions still open in this area. So they're running in drawdown. The central banks are running in drawdown at this point. So they bring price back down to that area to mitigate and close out those sell positions to take price where they wanted it to go in the first place. You see, because this is another area, but they didn't really worry about this area because this whole move was just to mitigate their risk. So this is just a kind of a brief overview of how I trade and why I think a lot of people fail in these markets, you know, because people think that, oh man, why did I get stopped out? So like somebody was trading this as a support and resistance. Dang, why my support get stopped out? Dang, why my resistance get stopped? I thought it was a breakout trade, you know. And you might look at this as like, come on, bro, that's so choppy. You can how can you tell it off this? Well, like I just showed you before, what does this look like to people who can see on time frames this low, right? Price bouncing up between the support and resistance and all of a sudden selling down extremely hard and selling up just as hard. You know how many people probably loaded up on buy or sell positions in this support and resistance range? And probably more people even loaded up on sell positions when they thought this was going to be a breakout trade when price broke down to the downside. And so what did price end up doing? I'm gonna explain another trade somebody could have caught. That's why I say it's important to understand. That's why I just explained earlier about the consolidation. When the market is consolidating, it's not just choppy or whatever the case is. They are accumulating or distributing orders. At this point, they were accumulating because whenever I say accumulating, that means they were accumulating and inducing people to get into the market so they could buy the market. Accumulation is for buy, distributing is for sale. So what do they do down here? Because this could have been a whole other trade I caught. I looked at this trade and I realized I could have caught another trade down here. So this was another accumulation, inducing people into the market, created a small, created a small trend line, swept that trend line, came back down to mitigate risk. You could have caught another entry right here. That would never have gotten tapped into. You could have literally caught another a 1 to 22, a 1 to 23. So just off of me understanding what the central banks are trying to do, why they're stopping people out, why they're collecting liquidity, collecting pending orders and all that, you could have caught 6%, 12%, another 23%. Now, these two trades are trades I actually caught, so I'm not going to sit up here and look at this one that I would have, could have, should have caught. I was done trading by this time, so even though I would have took this trade, seen this accumulation after it just swept liquidity, literally swept. People probably looking at this down here as a resistance now, and the central banks understanding that, and people looking at this as not a resistance. I forget retail terms now. People looking at this as a support. They're like, oh man, boy, them boys think we finna leave without snatching that liquidity too. Take the price we really want price to go. Hold on. Swept it, started accumulating, forming a range. Move this out the way. Forming a small range, selling climax, automatic rally, secondary test, spring, tested at spring, and high prices. I explain accumulation deeply in my course. If you don't understand the Richard Wyckoff theory, accumulation and distribution, that theory was created when trading was ever even first thought of. I mean, that theory is like the foundation of understanding smart money concepts. Just off me understanding this was an accumulation happening after liquidity was just absorbed, I knew probably they was trying to just transfer from weak hand to strong hand, induce more people to get into the market panicky, selling or buying or whatever the case is. This huge wick probably made people think, oh, price about to drop, and then wick back up after it basically took out this whole trend line almost. Price shot up, came back down, tapped into this area to mitigate risk before continuing price into their desired direction. Now, I'm probably going to make multiple parts to this, how to stop failing in Forex, but the main thing is, first, you have to understand where the liquidity is, where the money is, where are the masses entering in. And after understanding that, because this is scalping, you might be like, how can you trade the 1 second, the 5 seconds, the 10 second? I can look at the 1 minute. This is what I did. Look at the 1 minute time frame. Seeing what the 1 minute bias was alone. Drop down to the 5 second, the 10 second, the 1 second, and got an entry. 18% gain. 1 to 12, well, 18 RR gain. 12 RR trade and 6 RR trade. A lot of people are barely getting 1-to-1s, barely getting 1-to-2s, 1-to-3s. But on a normal day for me, scalping the 1 minute and time frames below, I'm getting 1-to-10s, 1-to-5 minimum. So, I mean, so I keep looking down. I'm looking at my charts while I'm doing this. I know the camera right here. I'm not used to this YouTube stuff yet. I'll be looking at the charts and trying to look at the camera at the same time. But Basically, all you have to understand first is where's the liquidity. And the bottom line is you need to have rules you follow. And don't get stuck in trying to beat an opponent that's obviously have everything they need to win against you. Ever heard the phrase, if you can't beat them, join them? That's the true definition of smart money concepts. If you can't beat them, join them. Why try so hard to make this trade work when the composite man has already induced you into wanting to make that trade work so he can use your open position of you, say, for instance, selling this market? Because I know what a lot of people did. All right, let me explain something that I didn't explain. A lot of people probably saw this trend line, right? Wow, this lines up perfectly. A lot of people probably saw this trend line, and you see right here, let's drop down some. This is the same area tapped up here, but this is also the same area that is swept down here, swept the liquidity down here, this double bottom, swept that on, I think, the 1 second. Sorry. It swept liquidity under this double bottom and accumulated right here. Right. And after they did that, what happened next? Price shot up. It took out everybody who was trading this 1 minute time frame as a trend line. Because I mean, it looks perfect, right? Lower low, lower high, lower low, lower high, lower low, lower high, lower low. It looks perfect. Perfect market structure. What did the central banks use it as? Liquidity. Money for them to collect to keep pressing price higher. They made moves in here to take all the people's sell positions and convert them into their own buy positions. I'm probably going to do more parts on YouTube like this, but this is the basic understanding. I know I might have skipped around a little bit, but everything's broken down into detail on the course. The main point of this was to kind of break down these two trades, what I saw, and help you understand on what you could have seen. Instead of being the people who are trading this trend line, jumping into a whole bunch of positions off this trend line, right? And all ended up getting coincidentally stopped out. You could have been the person who, like me, could have caught this whole move to get a 1 to 20, 1 to 30, 1 to 40, depending on how tight your stop was, depending on where you enter with the composite man. But like I said earlier, if I would have caught this last entry, because it was reasons, I ended up becoming a liquidity on both of these trades, but I only came to liquidity after I caught a 1 to 6 and a 1 to 12. But on this trade, I could have got one more entry. Do you think they would have took? Do you think they was? Does any of this show that they were looking to take the market back down to take me out one more time? No, because I was getting in with the composite man instead of against him. A lot of people might have started selling down here because of what? Another little trend line being created, right? Another trend line. More people started selling off this little trend line. But what happened? Price bought up. Because The compass man, the market makers, central banks, don't really care what you call them. They were looking to take this price up the whole time. All they were trying to do was get enough people to sell so they could keep buying. And once you understand that and the reason behind it, that's when you'll stop failing at Forex. Other than that, I'll keep making videos like this for YouTube, break down trades in more detail to help people go further. But I advise getting my course. It's going to help you out the most.